So what is the market doing these days? Even if you're just an index fund investor, still one day it might go up 2%, next day it might drop back down 2%. And if you're in tech or growth names, well, it's going to get even more volatile. Hey bulls and bears, it's Steven. With the uncertainty regarding taper, rate increase, inflation, and don't forget about the CPI data that just came out, well, it's all leading to increased volatility in the markets. The question that you should ask yourself is, how is the market affecting me? Not only financially, but also emotionally and psychologically. If you're just sitting back and enjoying the ride, well, good for you. Seriously, you're doing something right. But if the volatility is making you queasy, what can you do? Well, let me ask you a question. Would you eat something that's been in the back of your fridge for a few months?
Oh yes, it's very nice, sir.
Probably not, or I hope. And that's because you know it's probably not a good idea, and it's a risky choice. In a similar manner, why would you not try to mitigate your risk in your investment and trades? Learning to manage risk in investing and trading will not only reduce drawdowns, but also will keep your emotions in check. Think of it as buying insurance for your fur baby. Well, it might not be required per se, and might actually cost more than the actual vet bills. It could potentially save you money down the road if a major expense comes up, and the peace of mind is, well, priceless. I want to share 6 risk mitigating strategies and hedging strategies that served me well for both long-term investing, but also for the occasional short-term swing trades. Remember, I'm not a financial advisor, and this video is not financial advice. There isn't a single strategy that works well for everyone. Only you can decide on what works best for your situation. So let's get to it. Strategy 1, take some profit off the table. This is exactly what you think it is and what it sounds like. Take some profit off the table. As simple as it sounds, oftentimes when things are going well, I get overconfident and everything seems to be going to the moon when my stocks are going 2x, 5x, or even more. And at that time, profit taking doesn't even cross my mind until the price drops substantially. So let's take a look at the pros of the strategy. Well, you took profit and there's more money in your account. Go enjoy yourself, go buy whatever you want to buy, and enjoy life. This is also super affordable to do. There is minimal to no commission and fees to execute this trade with most brokerages, especially in the US. With all strategies, while there are pros, there's also drawbacks. There is potential a loss in opportunity to further profit if the stock continues to go up after you sold off. Well, you made the decision to sell off, right? So this is the trade-off that you're dealing with. For me, even with the long-term investor mindset, I find that taking some profit off the table really relieves my mind, and knowing that I captured part of that profit and now it is in cold hard cash, ready for me to do whatever I want to do with that. On to the second strategy, stop sell order and stop limit order. Most people are familiar with a market order, which is selling the stock at the current market price. It will work if you want to sell the stock as soon as possible, but if you want to sell the stock only if the stock drops below a certain price, then you could potentially place a stop order using a stop type as the order type. This type of order is also known as a stop loss or a stop sell order. So when you place a stop loss, the order does not get executed immediately, rather it waits until it drops below a preset price. To execute a stop loss, you would create a stop order as usual, but instead of selling with a market order type, you would select a stop order type. The pro of this strategy includes 1, it may reduce losses if the stock continues to go further down after the stop loss has been triggered. In this case, additional loss is mitigated and stopped by holding fewer shares of that stock. Number 2, This strategy is also very affordable to do and does not cost any more than executing a normal market order. For most individuals, it does not cost anything because fees, commissions are generally pretty low or even zero for a lot of major brokerages. On the other hand, let's take a look at the cons for the strategy. So a major con is the use of stop losses. You're prone to getting stopped out, especially in volatile markets where you might sell the stock only to see it rebound moments or days later. Another con is it is entirely possible that the stock does not sell at or even near the stop loss that you set. Here's an example. Let's say back in January 2022, you held shares of Facebook stock and you were worried that the quarterly earnings report might not be as favorable as you would hope, but you didn't want to sell off on the stock unless it drops. At that time, the stock traded between $300 to $350 per share. You could potentially set a stop sell order for the stock at the current market price at say $300. After earnings report on February 2nd, it gapped down to less than $250 overnight. Your stocks would have sold at the opening price of $244, but that's $50 less than the $300 stop loss that you set. While the order did get executed, the stock would have sold for much lower than the stop sell price. If you were expecting the order to execute at exactly $300, you would have been devastated knowing that you just lost more than $50 per share. On the other hand, if you tracked the stock for a few more days, you would have noticed that the stock kept going down even after it sold off at $244. When you see that, you would actually feel a sense of relief knowing that you didn't lose any more money than that. Let's tweak the stop loss a little bit and change it to a stop limit order instead. So what we're doing here is to add a limit order to the stop loss, which brings us to the second example. Say you're holding the same shares of Facebook stock as in the previous example, but instead of setting a stop loss order, you would set a stop limit order. You would set the same stop at 300, but in addition, you also add a limit which is lower than that of the stop. So let's say at 250, thinking that even though it might drop below 300 after the earnings report, there's no way that it will drop below 250, but we know that's not the case. This stop order that you set up will trigger only if it's below 300, but if it's above 250. Since it gapped down to less than 250 overnight and has not reached above 250 at the time of this video, this stop limit order would not have triggered. Now, do you see the difference between the stop loss and a stop limit order? Compared to the first example where the stop loss triggered, in the second example, the stop limit was not triggered. The remaining risk management strategies rely on the use of options. If you would like to see some content on options, please let me know in the comments below. As a quick overview of options, options are contracts that give you the right but not obligation to buy the shares of the underlying stock at the time of option expiration. For the remaining examples related to options, let's assume that you are holding 100% of the underlying stock. So this brings us to the third strategy, which is selling covered calls. The purpose of selling a covered call is to collect the premium that the buyer of the option will pay you as the seller of the option to have the right to buy 100 shares of the underlying stock at the strike price at the time of expiration. To implement the strategy, you would sell one covered call for every 100 shares of the underlying stock that you are trying to cover. This assumes that you own 100 shares of the underlying stock to begin with, or else it's not going to work. The pro here is that you're collecting a premium for agreeing to sell at the strike price. Compared to the previous strategies, you're actually earning some money here while you're mitigating your risk. So this is definitely a pro. The drawback for selling a covered call is that if the option buyer decides to exercise, then you must sell the shares at the strike price of your option. If you don't want to sell the shares, then that would be a drawback for you. Of course, there are ways to minimize the risk of your options being exercised, but I'll leave that for a separate video. Let's say you hold 100 shares of Microsoft and you want to generate some passive income through the premiums that you collect through selling these covered calls. At the time of this recording, Microsoft is trading at roughly $295. Say, for example, that your strategy is to select the strike price at 20 delta, which is roughly at 320 right now, which means that there is roughly a 20% probability that this option that you're selling will expire above 320, which will put this in the money. If the buyer were to exercise this option, which will force you to sell the 100 shares of Microsoft to the buyer at the strike price that you sold the call for. If you like the content that I'm sharing, it would help me so much if you can like this video and consider subscribing. This brings us to the fourth strategy, protective put. Let's say you have 100 shares of QQQ, an ETF that tracks the NASDAQ 100, but with all the market uncertainty, you think that there is more downside. So one strategy might be to buy a put option. Since you own 100 shares of the underlying stock, this will be considered a protective put option since your put contract is there to protect the underlying stock. Just as a reminder, one option contract is always equal to 100 shares of underlying stock, although there are some exceptions. The pro of the strategy is that it may protect against potential downside, but let's also consider the drawbacks. When you buy a put option, it costs a substantial amount of capital. This is unlike the previous strategies, which doesn't cost much at all to implement. Not only could this be expensive, it could also cost more than the money is trying to protect. Also, consider that this might require approval from your brokerage for options trading. In addition, if you're truly selling this as a protective put and not just a put, you will need 100 shares of the underlying stock. Let's check out an example, shall we? So let's say you're holding some NVIDIA stocks and you're bullish on the company in the long term. But with the market uncertainty right now, you want to reduce some risk by buying a protective put. So let's assume that you do have 100 shares of NVIDIA. With the stock trading roughly between 200 and 350 in the past few months, maybe you decide that you want to buy a protective put option with a strike price of, say, 200. What this would mean is that you, as the option holder, will have the right but not the obligation to buy 100 shares of NVIDIA stock back at the time of expiration if you so choose. On to the fifth strategy, the caller. The caller really is just combining selling a covered call and buying a protective put, which is strategy 3 and 4 combined. There are many variations of the caller, but the traditional caller will have the same expiration on the covered call and the protective put. The main benefit of this strategy is that you get to buy a put option hedge using the premium that you collect by selling the covered call. Depending on a number of different variables, you will at a minimum decrease the overall expense of the protective put. At times, the covered call you wrote will actually yield a higher premium than the cost of the protective put. This strategy provides you a protective put at a reduced price. The drawback here is that the caller is similar to that of selling a covered call. With this strategy, you're reducing the price of your hedge at the expense of limiting the potential upside in the event that the underlying stock actually continues to go up and the call option gets exercised. Another drawback is considering that the covered call may not fully cover the cost of buying the protective put, so you might need to put some of your own cash in there. That said, it's still cheaper than buying a protective put outright without selling a covered call at the same time. So let's go back to the example of NVIDIA from the previous strategy where you purchased a protective put. If you want to lower the cost of the protective put, you might also consider selling a covered call option to pay for the protective put. The increased risk that you're taking is there is a chance that your option might be sold if the covered call gets exercised. Last but not the least, number 6. You can also consider selling 100 shares of your equity and buy a deep in the money leap option that represents the same underlying stock. A deep in the money option is generally defined as having an 80 delta or above, which would mean that you have roughly an 80% chance or more that the option will expire in the money. The benefit is that you sell 100 shares of the stock and replace it with a deep in the money leap option that is likely only to cost about a third to maybe half of the cost to buy the actual underlying stock, which allows you to save the remaining dollars as cash. Since the amount of capital that you have invested is drastically reduced, it also means that the maximum loss is reduced. In addition, since a deep in the money leap option is intended to be a stock replacement that mimics the underlying stock, you would still maintain that 80+% of the upside potential when the price of the stock increases, all while reducing the capital invested. The drawback of the strategy is similar to that using a deep in the money leap option. In the event that the price of the underlying stock drops below the strike price, the option could potentially expire worthless. In my mind, this is the biggest risk since stocks don't generally fall all the way down to zero. Another risk to consider is theta decay or time decay, but this is relatively slow until 1 to 2 months before the option expiration. Since leaps are a year or two out, you have plenty of time before theta decay really becomes an issue. Here's an example. Let's assume you hold 100 shares of SPY, which tracks the S&P 500 index, and you're also a long-term investor who's bullish on the American market in the long term. But in the short term, the volatility is bugging you and you'll want to hold some more cash on the sidelines. Plus, the cash that you're holding on the sidelines could also help you to buy the dip. To execute the strategy, it's as simple as selling 100 shares of SPY and buying a deep in the money call option that's at least 12 months out. This summarizes the 6 risk mitigation strategies and hedges that I frequently use. But of course, there's so many strategies out there, so let's keep learning together. Hope you found this video helpful and learned a thing or two. If you would like to see more videos like this, please subscribe to my channel for more investing related content. Thank you and invest safely.